All right, so today I wanted to talk about a company that I've never talked about before. I was doing a little research. I kind of thought that, hey, I might want to get into a insurance company because I don't really have an insurance company in my portfolio at the moment. So I'm like, hey, let's do a little research. Let's run the screener. And I came across a handful of companies, but the one that caught my eye the most was Primerica, PRI. It is obviously an insurance company, $7.6 billion market cap. So they're a mid cap. Free cash flow yield of 9%. That's something that definitely impressed me. 1.23% dividend. The one thing that you notice initially about this company, it is up massively this year. It is up, 48% on the year, which is just crazy, right? I mean, that's crazy, especially for an insurance company, right? They're supposed to be these boring businesses that don't really do anything, but if you compare this company to the S&P, they've actually beat it over the last 5 years, actually fairly handily, 85% versus 61. So that's one of the many reasons why I'm interested in this company. Is it's beat the S&P, it's got a nice earnings yield, it's paying a dividend, which it's growing, which I'll get into. If we get into the insights here, this is the main matters right here. Again, the dividend I'll get into after. Financial health, it is in very, very, very good shape. I mean, that's one of the most important things when you're evaluating a business, because it's impossible, not literally, but borderline impossible for a business to go out of business if they have a very strong balance sheet. So that's one of the most important things that I look for, and I think any professional investor will look for. Because like I said, if you have a good balance sheet, you're good, you're very good. The growth, it is growing very, very nice, especially for an insurance company, right? Like I mentioned at the start, these are supposed to be these slow growth, kind of boring businesses, which isn't really the case here. It is fairly profitable, 20% operating margin, 14.5% net margin, so that's nice. Another very good point here is the management is doing a very, very, very good job, right? A very good job, and that's something that, another very important thing, right? You need good management, right? Because if you want the business to go over the long run, you really need good management. I did mention earlier that this company grew 48% this year, so the first thing that probably would come up is, okay, they must be expensive. And that's debatable. The price of sales is actually a tiny bit below the 5-year average. The PE is slightly above, 15.4 versus the 5-year average of 13.8. But I would argue that 15.4, again, this is a company that's beating the S&P. And the S&P, I believe their PE, I'm almost certain their PE is more than this. I think it's in that like 18 to 20 range, right? So this is a company that's beating the S&P, that is cheaper than the S&P. So ideally you would pick this company up cheaper. So again, obviously everything here, my opinion, but ideally you would pick it up cheaper, but it appears to be about fair value, if I'm being honest, in my opinion, right? So again, let's get into the dividend. This is another thing that really, really turned me on to this company. Again, only 1.23%, but again, my investing strategy or criteria, I don't care what the existing dividend is, because that's irrelevant, because you're not investing for today, you're investing for decades down the road, most likely, right? The most important thing here is they're growing at 21% a year. The payout ratio is 19%. On free cash flow, it's 13%. Right? So again, look at this dividend growth. If you'd have bought this company 10 years ago, you'd have a 8% yield on cost, right? So that's why I'm buying this company, right? Because 10 years from now, I'm going to have a 7% yield on cost, right? That's why you buy it, right? The last thing we'll get into here is the valuation. Let's get into the valuation here. All right, so if we go back about 10 years, I have the price to operating cash flow, price to free cash flow, and the risk premium. So if we look at the chart here, the average price to free cash flow has been 10.9. The latest is 11.3. The average price to operating cash flow is 10.2. The latest is 10.6. So again, they're actually slightly above both of those. Let's check the PE just for, actually that's the wrong place there. Yeah, so the average PE, sorry, has been 13.99. So essentially 14. The latest is 15.4. So they're right around it, right? They're right around it. And I mean, if you look quite honest, I mean, the highest the PE has ever been 19.6, and the lowest has been 8.24, right? So again, they're pretty well fair value where they're at. But if you look at the chart here, I mean, it looks like in 2017 they hit that high, and then in March of 2020 they hit that low, right? So this company basically never goes below a PE of about 11, it looks like, and it never really goes above, let's see, aside from that one time, it never really goes above about 16 and a half, right? 16, maybe 17. Where did it get to here? Just under 17. Here it went to 16. So again, they're pretty well right within that range, that realistic range of 11 to 16, right? So again, in my opinion, it's right about fair value where it's at. I'd love to get it cheaper, but I will dollar cost average until one of two things happens, right? It goes above that 17 mark, or below the 11 or 12 mark, in which case I'll jump in further. If it goes above, I'll stop buying. That's just my personal opinion. If you like the video, please comment, like, subscribe, all that good stuff, and stay tuned for more.